Last time you opened a basket, you learned what an ETF really is: a single share that quietly holds hundreds of companies at once. But that left a much harder question hanging in the air. If you can buy the whole basket in one click, should you ever bother picking the individual companies inside it yourself? Stocks or ETFs? Which one is actually better? By the end of this video, you will know the honest answer, and more importantly, you will know which one is better for you. Let's start with the real difference, because it is simpler than people make it sound. When you buy a single stock, you're buying a piece of one company. One business, one story, one fate. When you buy a broad ETF, you are buying a thin slice of many companies at the same time. Many businesses, many stories, many fates, all bundled together. Everything else you will ever hear about this debate flows from that one distinction. One bet, or many bets at once. So why would anyone choose the single stock? Because a single stock is the only way to truly win big. If you put your money into one company and that company becomes the next giant, your returns can be life-changing in a way the whole market never matches. Imagine having owned just Apple or just Amazon in their early days. A few $100s could have become a small fortune. That is the dream the single stock sells you, and it is a real dream. It does happen, but here is the catch, and it is a heavy one. The same concentration that can make you rich can also wipe you out. When you own one company, you own all of its risk. A bad product, a scandal, a new competitor, one disastrous decision, and the stock that was going to change your life can fall and never recover. You're not spreading your bet. You're placing it all on one square. History is full of these falls. Think of companies that once looked unbeatable and then quietly disappeared. Kodak, which practically invented the consumer camera and missed the digital age. Nokia, which once sold most of the phones on Earth. Blockbuster, the giant that laughed at a tiny startup called Netflix. Every one of those was somebody's favorite stock, somebody's sure thing. Owning one company means living with the possibility that your sure thing becomes the next cautionary tale. This is why the ETF exists and why so many people prefer it. When you own a basket of 500 companies, no single failure can sink you. If 3 of them collapse, the other 497 carry on. You give up the chance of one explosive jackpot, and in return you get something most people value far more: the near certainty that you will not be ruined by a single mistake. You trade the thrill of the lottery for the calm of the crowd. Now, this is not just a feeling, and this is where the real evidence comes in. We actually have hard numbers on whether picking stocks beats buying the basket, and they are humbling. A finance professor named Hendrik Bessembinder at Arizona State University studied nearly a century of American stocks. He found something startling. Most individual stocks, over their lifetimes, did not even beat a boring government savings bond. The entire net gain of the whole stock market came from a tiny handful of huge winners. In other words, if you pick stocks at random, the odds say you will most likely pick a mediocre one, and you will miss the few rockets that carried everything. There is a second piece of evidence, and it is even more famous. In 2007, Warren Buffett, the most respected investor alive, made a public bet worth $1 million. He bet that a simple, cheap S&P 500 index fund would beat a hand-picked collection of elite hedge funds over the next 10 years. These were professionals, paid enormous fees, working full-time to pick winners. 10 years later, Buffett won, and it was not close. The plain index fund returned about 7% a year. The clever professionals returned barely 2%. The basket beat the experts, and it is not a one-time fluke. Every year, a scorecard called SPIVA, published by S&P Dow Jones Indices, measures how professional stock pickers do against the index. Year after year, over long stretches, the large majority of them lose. If the highly paid experts mostly cannot beat the basket, it is worth being very honest with yourself about your own odds of doing it in your spare time. Let me make all of this concrete with 3 quick examples, because numbers become real when you can picture them. Imagine 3 different people, 10 years ago, each with the same $10,000. The first person bets everything on a single winner. They pour it all into one brilliant technology company, and they get lucky. That company becomes a giant. Their 10,000 turns into 100,000. This is the story that gets posted online, the story that makes single stocks so seductive. It is real. It is also rare, and it could just as easily have gone the other way. The second person also bets on one company, with just as much confidence. But they chose a former champion that slowly lost its way, the Kodak of their decade. The business eroded, the stock slid, and their $10,000 shrank to 2. Same strategy as the first person, same conviction, completely opposite ending. This is the half of the story that nobody posts about. The third person does something far less exciting. They put the whole 10,000 into a single broad market ETF and barely look at it again. They never feel the rush of the jackpot, and they never feel the gut punch of the collapse. They simply own a little of everything, including both the winner and the loser from the first two stories. Over the decade, their money roughly doubles or more quietly with no drama. They did not win the lottery. They also never had to. Look at those three together, and the trade-off becomes obvious. Single stocks offer the widest range of outcomes, from spectacular to devastating. The ETF deliberately throws away both extremes and keeps the steady middle. Neither is cheating. They are simply two different deals, and you get to choose which deal you want. So, which is better? The honest answer is that it depends entirely on three things about you. The first is time. Picking individual stocks, well as real work, reading reports, following the business, staying informed. If you do not have that time, the basket is almost certainly better for you. The second is knowledge. Do you genuinely understand the company? Or do you just like the logo? If you cannot explain why a business will make money, you're not investing, you are guessing. And the third is temperament. When your one big stock drops 30% in a week, will you hold calmly, or will you panic and sell at the bottom? For most people, most of the time, the truthful recommendation is simple. Build the core of your investing on broad, low-cost ETFs, the boring basket that history says is very hard to beat. Then, if you truly enjoy it and you can afford to be wrong, you might keep a small slice of your money for a few individual companies you understand deeply. Many calm investors do exactly that. The basket is the foundation. The single stocks, if any, are a small, conscious experiment, not the whole house. There is no shame in choosing the basket. Choosing ETFs is not admitting you are not smart enough to pick stocks. It is recognizing that even the smartest, best-paid professionals mostly fail to, and deciding you would rather quietly own the whole market than bet your future on being the rare exception. That is not weakness. That is one of the most rational decisions in all of investing. So back to the basket you opened last time. Now you know you do not have to choose between feeling clever and sleeping well at night. You can own the whole market in one click, capture nearly everything the economy creates over a lifetime, and skip the heartbreak of betting it all on a single name. Stocks can make you rich, and they can break you. The basket just quietly carries you. Which one is better is not really the question. The real question was always which one is better for you, and now you can answer it honestly. I will see you in the next one. Until then, keep it simple and never bet the whole house on a single square.